In August 1990, Oracle Corporation told its shareholders that 3 of the previous 4 quarters had been reported incorrectly. Within months, the stock had lost nearly 80% of its value. The company had to cut 10% of its workforce, arrange an emergency line of credit, and replace its chief financial officer. And then it staged one of the great comebacks in corporate history. Oracle brought in professional management, rebuilt how it recognized revenue, and over the following decade grew from less than $1 billion of annual revenue to more than $10 billion. And anyone who bought at the 1990 low and simply held made many multiples of their money. 36 years later, in July 2026, Oracle trades at $117, down more than 60% from $346 peak. $476 billion of market value has disappeared in just 9 months. Its 5-year credit default swaps sit at the highest level in their history, and Standard & Poor's has cut Oracle's credit rating to just 1 notch above junk rating. So the question writes itself. What is Oracle going through now, and whether this is a repeat of 1990 fall and comeback? Nobody can answer that directly, but Larry Ellison has been building this company for almost 50 years, and he has won using the same handful of moves over and over: how to attack a market, how to sell, and what to own. So if we understand this formula properly, we can at least ask which parts of it are genuinely present in today's cloud bet and which parts are missing. So this is not a forecast. It is a look at the track record and an honest comparison with what is happening now. To understand Larry Ellison's current playbook against the cloud giants and large investment into AI, you first have to understand the trade that built Oracle nearly 50 years ago. In 1970, an IBM researcher named Edgar Codd published a paper describing the relational model for databases. By the middle of the decade, IBM had a working prototype called System R. So IBM had the idea, the research, the engineers, and the customers. However, IBM also had IMS, a hierarchical database running on mainframes and already generating enormous profit. The new relational databases threatened that existing profit, and so IBM moved slowly. This is the reason why Larry Ellison, Bob Miner, and Ed Oates founded software development laboratories in 1977 and shipped Oracle version 2 in 1979. Interesting fact is that there was never a version 1. The number was a marketing decision on the theory that no enterprise buys version 1 of a database. Even then, version 2 was incomplete and, by contemporary accounts, unreliable. Nevertheless, it was the relational model for database because IBM's commercial product did not arrive until 1981. This 2-year gap was not a technology gap. It was the time it took a large entrenched IBM to decide to damage its own most profitable product line. And this aggressive bet on the new thing when he has conviction is the trade Ellison has run ever since. This brings us to the cloud market, where he got it badly wrong first. In 2008, Ellison publicly dismissed cloud computing as a marketing fashion. And thanks to his mistake, Amazon compounded unchallenged in its early years. Oracle finally shipped its own infrastructure product in 2016. But even then, it was essentially an imitation of Amazon's design, except worse, and failed. So, in 2018, Oracle threw it away and started all over again. That reflex matters, and we will see it more than once. When something Oracle built does not work, it tends to admit and then demolish rather than defend itself. In this second-generation cloud design, Oracle made an important change. In a conventional cloud, the software that manages virtual machines consumes host processor and memory, and the tenant receives what is left. In contrast, Oracle's new design hands the tenant the whole machine and then adds a high-bandwidth RDMA fabric between them. And notice what that attacked. Amazon and Microsoft built their clouds on multi-tenant virtualization and charged customers for data leaving the network. Both were enormously profitable and therefore expensive to abandon, which is structurally the same position IBM was in with IMS, and so Oracle's differentiation worked. The irony is that Oracle built the architecture for latency-sensitive enterprise databases, but luckily, when AI proliferated, large-scale AI training turned out to want precisely the properties that Oracle built. This is one of the key reasons why Oracle could join the Stargate project and sign OpenAI as its key cloud customer. But this is where the parallel weakens, and it is worth being precise about why. IBM in 1977 was a slow giant. However, Amazon, Microsoft, and Google are not slow at all. They design their own AI silicon, run purpose-built AI fleets, and borrow considerably more cheaply than Oracle does. Oracle's quarterly cloud infrastructure revenue is $5.8 billion, while Amazon Web Services generated $37 billion in a single quarter. So Ellison is running the same play, but this time against an incumbent more than 6 times his size that is wide awake. In 1983, Oracle rewrote its database in the C programming language. Described that way, it sounds like an engineering footnote, but it was probably the highest return decision in the company's history. Because before this rewrite, database software was tied to specific hardware. But afterwards, Oracle ran on DEC's VAX, on Unix, on IBM mainframes, and later on Windows. So customers' hardware choice simply stopped mattering, and so whatever machine an enterprise bought, Oracle retained its database business. Some companies that chose differently and stuck with its hardware had to suffer. For example, Ingress had arguably better engineered database, but it stayed close to its original platforms and was sold in a distressed sale in 1994. Sybase built deeply into a narrower stack, and by the late 1990s it was one-tenth Oracle's size, and stayed there. So Oracle never tried to win the hardware war. Instead, it won by making hardware interchangeable and then owning the layer above it. And that exact move is running again right now. Since 2023, Oracle has been installing its own hardware racks physically inside its competitors' data centers, Oracle Database at Azure, at Google Cloud, and at AWS, so that a customer running on Microsoft's cloud can use Oracle's database as a native service. By the end of fiscal 2026, there were a total of 69 live regions in competitors' data centers. And thanks to this change, revenue from that business grew 404% in the second quarter, with bookings up 325%. And more importantly, unlike huge AI investment that Oracle is making at the moment, this growth consumes almost no capital. Here, the more interesting question is why Amazon, Microsoft, and Google allowed Oracle to install hardware in their own data centers, which is an extremely rare move. Because on the face of it, they are handing precious rack space to a direct cloud competitor. And the answer is the strength of Oracle's old business. Oracle's database still sits underneath a very large share of the world's mission-critical enterprise systems, and those workloads are extraordinarily difficult to move. The data models, the stored procedures, and the compliance certifications are all built around it. So when a large bank migrates to Microsoft Azure and says it does not want to rewrite its core banking system, Microsoft has two options. Refuse the client and lose the entire workload, or let Oracle in with the client. That is what a moat actually buys you. Not just pricing power in your own market, but the ability to walk into someone else's. The limit of that leverage is what to watch, though. The moat is specific to the database, and the database is what gets Oracle through the door. It does not automatically extend to AI compute, where Oracle is competing with those same hyperscaler partners rather than being tolerated by them. It has worked so far because both sides profit from it. Whether it keeps working is a question nobody can answer yet. Oracle's sales culture in the 1980s was deliberately extreme. Ellison at one point paid bonuses in gold coins, and the instruction was simple. Win the contract first and let engineering catch up. The accounting followed the culture. In those days, Oracle recognized revenue when a contract was signed rather than when the software was delivered, so deals were routinely booked before the product shipped. And it worked. That is the uncomfortable part. Selling ahead of the product is how Oracle took the market from IBM, Ingress, and Sybase, and it is a large part of how a startup became the default database of corporate computing. The same instinct is the loudest parallel in the story today. Oracle's backlog, its remaining performance obligations, ended fiscal 2026 at $638 billion against total annual revenue of just $67 billion. That is a backlog roughly 9.5 times revenue. On the other hand, Microsoft's commercial backlog is a comparable $627 billion, but it sits against a revenue base more than 4 times larger, which puts Microsoft's ratio near 2 times. So Oracle is once again selling much further ahead of what it has actually built than anyone else in its industry. Two things separate then from now though, and they point in opposite directions. The first is reassuring. In the 1980s, the accounting was genuinely aggressive, and eventually it broke, causing the steep stock price fall that we saw before. But today, Oracle is not aggressive in accounting. Remaining performance obligations, RPO, are a required disclosure, they are contractual, and $75 billion of the backlog is already prepaid or built on hardware the customer actually supplied. But the second is not reassuring at all, and it is the single biggest break in the whole 50-year pattern. That is, every previous Ellison bet was funded by customers. Software cost almost nothing to reproduce, gross margins ran near 90%, and each additional copy sold was close to pure profit. But his current bet on AI is different. Fiscal 2026 capital expenditure was $55.7 billion, up more than 100% from $21 billion a year earlier. And the company's free cash flow became negative $23.7 billion. In order to build new data centers, Oracle had to raise $43 billion of debt and $5 billion of equity in a single year, and guides to another $40 billion of financing in fiscal 2027. In the 1980s, selling ahead of the product risked a restatement of financial statements, but in 2026, it risks a funding and solvency problem. By the 2000s, Ellison had stopped inventing moats internally and started buying them. PeopleSoft acquisition cost $10.3 billion after an 18-month hostile campaign. Siebel cost $8.5 billion, and Sun Microsystems cost $7.4 billion. And those were three of more than 50 acquisitions in less than 5 years. Judging on results, it was one of the most successful acquisition programs in the history of enterprise software. Oracle went from selling a database to owning the applications sitting on top of it: finance, HR, customer records, whole industry systems. And each layer it added made the layer beneath it harder to remove. And as a result, revenue and margins compounded on these successful M&As for 2 decades. But some deals looked like a mistake for a very long time. For instance, buying Sun in 2010 put Oracle into hardware business at exactly the moment the industry decided that hardware was just commodity. However, this still gave Oracle the capacity to design and operate its own machines when it rebuilt its cloud business in 2018. So that is the second time in this story that an apparent failure turned into the foundation of the next win. That accumulated estate is what separates Oracle from new cloud companies like CoreWeave and Nebius. Their product is just compute, and compute on its own is close to a commodity. Whoever has chips and power can sell it. Unlike them, Oracle can provide additional values to clients, such as the database already holding the customer's operational data, plus the applications that generate that data, plus 69 live regions inside the competitor's clouds. So on differentiation, OCI sits clearly above the new clouds. Nevertheless, Oracle does not sit level with the 3 hyperscalers, and it is worth being honest about the gap. Amazon, Microsoft, and Google have their own silicon, their own frontier model relationships, far larger developer ecosystems, and much lower cost of capital. Oracle's advantage over the new clouds is real, but its disadvantage against the hyperscalers is also real. And there is one inversion here with no precedent at all. The durability of Oracle's old moat came from diffusion. Tens of thousands of enterprises, none of them individually important. Yet, Standard & Poor's estimate that roughly half of today's $368 billion of backlog sits with a single customer, OpenAI. And 4 customers each concentrated more than $8 billion in the second quarter alone. So Ellison spent 40 years building a business that no single customer can break, but is now betting on a cloud infrastructure business that could be broken down by just one large customer. So where does that leave us? Oracle's market cap peaked near $820 in October 2025, and by late July 2026, it was around $340 billion. And as we saw before, its CDS and credit rating all reflect high risk of Oracle's aggressive AI data center investments. But at the same time, we saw that the 4 parts of Ellison's business formula that made Oracle hugely successful are also genuinely present. Oracle is, again, attacking incumbent constrained by its own economics. It is again using the database mode as a Trojan horse, this time straight into its competitors' data centers. It is again selling far ahead of what it has built. And it has again rebuilt from scratch rather than defending a design that was not working. But 3 things have no precedent in the previous 50 years. First, the bet is funded by borrowing rather than by customers. Second, the asset depreciates rather than compounds. In the past, every database installation made the next one easier, whereas now, a GPU fleet decays against silicon superseded roughly every 18 months. And third, customer concentration has replaced diffusion, which is why the 1990 comeback is an imperfect guide. Interestingly, current Oracle still has the deep moat and highly successful SaaS business inside, and is just adding the cloud infrastructure business, so we have to de-average and analyze each engine separately. But that is a topic for another video. I genuinely do not know how the current data center investment ends, and I would rather not pretend otherwise. But I would like to hear what you guys think. Does Oracle make another historical comeback from here? Or is the market right to be pricing a funding problem? Please leave a comment, and also let me know if you would like to see the numbers-based scenario analysis of Oracle. Thanks guys.